Hey everyone, welcome back to Corporate Decoder, the place where we take boring financial documents and turn them into, well, slightly less boring and hopefully more understandable insights. Get ready because today we're diving into a report that's all about loans and maybe a little less about cash flow than we'd like. Before we dive in, if you enjoy these straightforward breakdowns of financial filings, hit that subscribe button. And hey, we've got a lively Discord community discussing these reports linked in the description below, so come join the conversation. Alright, so what are we looking at today? This is a Form 8K filing from T-Series Middle Market Loan Fund LLC, and it's about a pretty significant event. They're amending and restating a big loan and security agreement. Think of it like this: a company gets a massive loan to fund its operations, and then it goes back to the bank to slightly change the terms of that loan. That's the main story here. The company involved is T-Series Middle Market Loan Fund, LLC. As the name suggests, they're in the business of lending money specifically to middle market companies. These are generally businesses that are too big to be considered small businesses, but not quite large enough to be considered major corporations. Now, this form is a current report, meaning it's disclosing a really important event that's happening right now. It's not a regular check-in like a quarterly report, but more like a hey, something big just happened announcement. They also have these checkboxes asking if this filing is meant to cover other communications, like selling materials or pre-commencement notices for potential takeovers. It looks like none of those apply here, so they're just sticking to the core news. Interestingly, when you look at what securities this company has registered, it says none. That's a bit unusual for a company, but it's not uncommon for certain types of funds or special purpose vehicles. It basically means they aren't actively trading shares on a major stock exchange under their own name in the way you might expect. Here is something I always like to point out. This company has checked the box indicating they are an emerging growth company. This means they get to follow some scaled down reporting requirements, which can be a bit of a double-edged sword. While it might mean less onerous reporting for them, it can also mean less transparency and detail for us investors trying to figure out what's really going on. They've also elected not to use the extended transition period for new or revised accounting standards, meaning they're adopting them right away. Okay, now we're getting to the good stuff. This section, item 1.01, tells us about the big agreement. What happened is that T-Series Financing SPV Third LLC, which is a wholly owned part of T-Series Middle Market Loan Fund LLC, changed its loan agreement. This updated agreement is called the Amended and Restated Loan and Security Agreement. So who are the players here? You have T-Series Financing SPV Third LLC as the borrower. The main company, T-Series Middle Market Loan Fund LLC, is the parent and servicer. Then you have US Bank Trust Company National Association acting as the collateral agent and administrator, and US Bank National Association as the securities intermediary. The big players on the lending side are the JPM lenders and JPM Morgan Chase Bank, National Association acting as the administrative agent. This whole setup is called the JPM Funding Facility. It's a line of credit that allows T-Series Financing SPV Third LLC to borrow up to a whopping $500 million at any one time. That's a massive amount of money, and it shows the scale of their lending operations. Now, what exactly changed in this amended agreement? The most significant change mentioned here is a reduction in the interest rate, or as they call it, the margin. For loans that are tied to a reference rate, this margin has dropped from 2.35% per year down to 1.90% per year during the reinvestment period. To raise an extra bit for pound sterling advances. But the key takeaway is that borrowing has become cheaper for them. A nearly 0.5% reduction on such a large facility can save them a significant amount of money over time. This often happens when the lender feels more confident about the borrower's ability to repay, or when the market conditions for lending have improved. It can also be a sign that the borrower has more leverage now than they did before. This next section, item 2.03, basically just says that the information we just covered in item 1.01 is also relevant here. It confirms that this updated loan agreement creates a direct financial obligation for the company. It's not some hidden or off-balance sheet deal. It's a solid commitment that impacts their financial health. And finally, item 9.01 lists all the extra documents attached to this filing. The most important exhibit here is exhibit 10.1. This is the actual amended and restated loan and security agreement. This is where all the nitty-gritty details of the deal are written out. They've omitted certain schedules, which is pretty common to keep the filing a bit more streamlined, but they've promised to provide those schedules to the SEC if they ask for them. So what's the story here? T-Series Middle Market Loan Fund LLC, a company that provides loans to other businesses, has successfully renegotiated its own massive borrowing facility. They've secured a loan of up to $500 million, and importantly, they've managed to get better terms, specifically a lower interest rate, for a company that makes money by lending. Having access to cheaper money is a big deal. It means they can potentially earn more on the loans they provide, or they can pass those savings on to their borrowers to be more competitive. This move signals a level of confidence from their lenders, JP Morgan Chase, that T-Series is a stable and reliable borrower. It also shows that T-Series is actively managing its cost of capital, which is a crucial aspect of running a successful lending business. Now, looking at this filing, it's primarily about the debt restructuring, not about their performance in lending out money. We don't have revenue numbers or profit margins from this specific report. It's like getting an update on a chef's ingredients delivery system, not on the taste of the food they're cooking. However, the fact that they are able to secure better terms on their own financing suggests that their underlying lending operations are likely going well enough for the banks to trust them with so much money. A key risk to consider any time a company has a large debt facility like this is what happens if the underlying loans they've made start to go bad. If their borrowers can't repay, T-Series could face problems servicing this debt even with the improved terms. Also, as an emerging growth company, we need to keep an eye on how quickly they adopt new accounting standards and whether that impacts how their financial picture is presented moving forward. In conclusion, this 8K filing is a positive sign for T-Series Middle Market Loan Fund LLC. They've improved their cost of borrowing on a very substantial loan, which is a smart move for a company in their line of business. It suggests financial stability and potentially an improved ability to profit from their lending activities. While we don't see their lending performance detailed here, the improved credit terms are a strong indicator that things are on the right track. What is your take on this kind of financing deal and what it means for a loan fund? Let us know in the comments below if you found this deep dive helpful. Please give this video a thumbs up and subscribe for more, and don't forget to join our Discord community for more discussions like this. Thanks for watching, and we'll see you in the next one.